Hello CMA final students. Now in part 4 of transfer pricing, I am going to explain two most important sections. First one is section 92 CE secondary adjustment. Afterwards, I will discuss section 94B thin capitalization, interest paid to associated enterprise. Section 94B is very important. In last 2-3 attempts, in every attempt one question, 7 marks question is asked from section 94B. That much important it is. So this lecture is very important and useful. If you listen to this lecture, definitely you can score 7 marks. Okay, so don't pause this video, don't stop watching this video, watch this video till the end. Okay, first, secondary adjustment. Before I discuss with you secondary adjustment, you all know primary adjustment, right? First let us discuss primary adjustment. Let's say there are two companies, Rama Limited and there is Bob Limited. Rama Limited is basically Indian company, Bob Limited is basically company located in USA. But Bob Limited holds 36% shareholding in Rama Limited. So we can tell Rama Limited and Bob Limited as associated enterprises. Correct? Now, Rama Limited sold goods to Bob Limited. Actual sale is 10 crores. Okay, but arm's length price sale is 4 crores. Generally, under sales are there. Actually, there should be arm's length price sales are 14 crores. Actually, they should be sold at 14 crores. But with associated enterprise, what is the sale price at which they are sold? They are sold for 10 crores. Now, how much is under sale? Under sales. Under sales are 4 crores. 4 crores will be added to income of SSC. Now, whatever 4 crores added to income of SSC is there, this we call as primary adjustment. Okay, primary adjustment. 4 crores. Did you understand? That 4 crores we call as primary adjustment. Now, the point is, actually goods should be sold for 14 crores, but goods are sold only for 10 crores. Whatever the 4 crores is there, this is excess money. That excess money is lying with Bob Limited associated enterprise. Actually, Bob Limited should give 14 crores. But whether Bob Limited gave 14 crores to us? No. Bob Limited gave only 10 crores to us. Excess money 4 crores lying with Bob Limited. Now, whatever excess money of 4 crores is there, money of 4 crores should be brought to India within 90 days. Should be brought into India within 90 days. Sir, from which date 90 days is calculated? That I am going to explain little later. But the thing is, 4 crores should be brought into India within 90 days. Whatever the excess money with Bob Limited, it should be brought into India. If excess money is not brought into India, excess money is not brought into India, then not brought into India within 90 days. In such case, 4 crores will be deemed as loan given to associated enterprise. Loan given to Bob Limited being associated enterprise. Okay. Now, whatever 4 crores deemed as loan is there, this we call as secondary adjustment. Are you able to understand? The point is, whatever the excess money of after comparing with arm's length price, that excess money is to be brought into India within 90 days. If excess money is not brought into India within 90 days, then excess money will be deemed as loan given to associated enterprise and interest income will be added. And interest income will be added. till such amount is brought back to India. Till how much period that interest income will be added? Interest income will be added till such amount is brought into India. That concept we call as secondary adjustment. Primary adjustment means excess money. We will add excess money to the income of the SSC. Now whatever the excess money is there, that should be brought into India. If it is not brought into India, that excess money will be deemed as loan given to associated enterprise, and every year interest income will be calculated, and such interest income will be added to total income of the SSC till that excess money is brought into India. That concept we call as secondary adjustment. Are you able to understand? Now, next, I told excess money should be brought into India within 90 days. Sir, from which date 90 days is calculated? That we will see. See, secondary adjustment is not applicable in every case. Secondary adjustment is applicable in 5 cases. What do you mean by secondary adjustment? Excess money should be brought into India within 90 days. If it is not brought into India, it will be deemed as loan given to associated enterprise, and interest income will be added. Such addition of interest income, if excess money is not brought to India, we call as secondary adjustment. Okay. The concept of secondary adjustment applicable in 5 cases is applicable in 5 cases. Case 1, SSC made primary adjustment on his own motion. That means what? SSC himself calculated the arm's length price. If SSC himself calculates the arm's length price, then SSC is required to bring excess money to India within 90 days from ITR due date. Are you able to understand? So, excess money to be brought into India within 90 days from ITR due date under section 139(1). Did you understand? That is case 1. That means SSC himself calculates arm's length price. SSC himself has done primary adjustment. Then SSC has to bring the excess money to India within 90 days from ITR due date under section 139(1). Next, case 2. Assessing officer made primary adjustment and SSC accepted the primary adjustment, and SSC accepted primary adjustment. In this case, that means what? I calculated arm's length price as 10 crores. Income tax officer came. He calculated arm's length price as 14 crores. So, as per assessing officer, arm's length price is 14 crores. Excess money 4 crores I have to brought to India. Then 90 days will be calculated from which date? In this case, excess money to be brought to India within 90 days from date of assessment order. Within 90 days from date of assessment order. Are you able to understand? Third case. That means the date on which assessment order is came. From that date onwards, within next 90 days, I need to bring excess money to India. If I do not bring that money, it will be deemed as loan given to associated enterprise, and on such deemed loan, interest income will be added to total income of the SSC till the time that excess money is brought to India. Are you able to understand? Next, third case. Primary adjustment is due to advance pricing agreement. In part 3, I discussed clearly about APA, advance pricing agreement. Primary adjustment is due to advance pricing agreement. See, if advance pricing agreement, if APA is entered before due date of return of income, if APA entered after due date of return of income, if advance pricing agreement is entered before due date of return of income, then excess money to be repatriated within 90 days from actual ITR filing date. That means whatever the ITR filing date is there, from ITR filing date, you have to repatriate the money to India within 90 days. If advance pricing agreement is entered after due date of return of income, then excess money to be brought into India within 90 days from end of the month in which APA is entered. Advance pricing agreement is entered. For example, let's say APA entered before due date of return of income for previous year 24-25. Okay, let's say APA entered on 10th September 2025. Actually, what is ITR due date? ITR due date is 30th November 2025. Before ITR due date only APA was entered. Okay, APA entered before ITR due date. Now, ITR due date is 30th November 2025, but actual ITR filing date is 12th December 2025. Now, from 12th December 2025, you have to calculate 90 days. Are you able to understand? See, not from ITR due date, from actual date of filing ITR. ITR due date is 30th November. Actual ITR filing date is 12th December. As APA entered before ITR due date, excess money is to be brought to India within 90 days from actual ITR filing date. Are you able to understand? Did you understand? Good. So 90 days from actual ITR filing date. Did you understand? If APA entered after due date of return of income, excess money is to be brought to India within 90 days from end of the month in which APA is entered. What do you mean by this? Let's say for 24-25, ITR due date is 30th November 2025. APA entered on 21st December 2025. APA entered after ITR due date, right? So 21st December 2025, you have to take end of the month. What is end of month? End of month is 31st March 2025. Sorry, 31st December 2025. From end of 31st December 25, you have to take 3 months. 31st March 2026. Within 31st March 2026, 90 days. I am sorry, not 31st March 2026, 90 days. Calculate January 31, February 28, March 31. Correct. 31st March 2026. Within 31st March 2026, excess money is to be brought to India. Are you able to understand? So, very simple. APA entered before ITR due date. Then excess money is to be brought to India within 90 days from actual ITR filing date. If advance pricing agreement is entered after ITR due date, in that case, excess money is to be brought to India within 90 days from end of the month in which APA is entered. Are you able to understand? Next, case 4 and case 5. If primary adjustment is due to safe harbor rules, case 5, if primary adjustment is due to mutual agreement procedure. These two are not that much important, so that's why I am not teaching here. No question was asked till now from these two, but first three are important. If primary adjustment is done on suo motu basis, then excess money is to be repatriated to India within 90 days from ITR due date. If assessing officer has done primary adjustment and SSC accepted the primary adjustment, then excess money is to be brought to India within 90 days from date of assessment order. Are you able to understand? Next, if primary adjustment is due to advance pricing agreement, in that case, we have to check whether APPA is entered before ITR due date, if APPA is entered after ITR due date. If APPA is entered before ITR due date, excess money is to be brought to India within 90 days from actual ITR filing date. If APPA is entered after ITR due date, excess money is to be brought to India within 90 days from date of within 90 days from end of the month in which APPA is entered. Are you able to understand? This is the scenario. Next, what I said, if excess money is not brought to India within 90 days, then what is the consequence? Interest income will be calculated. Sir, what is the rate of interest? Okay. Interest rate. If transaction is denominated in Indian currency, if transaction is denominated in foreign currency, if transaction is denominated in Indian currency, then rate of interest is SBI 1 year marginal cost of lending rate. Marginal cost of lending rate as on 1st April of previous year. To this, you have to add 3.25%. That is the interest rate. If transaction is denominated in foreign currency, then 6 months LIBOR as on 30th September of previous year plus 3%. Are you able to understand? That is the interest rate. So transaction denominated in Indian currency, SBI marginal cost of lending rate as on 1st April plus 3.25%. If transaction is denominated in foreign currency, interest rate is 6 months LIBOR as on 30th September of previous year plus 3%. Next, sir, from which date interest is calculated? Interest is like for example, ITR due date 30th November of 2025. Within 90 days, excess money is to be brought into India. That means what? December 31, January 31, February 28th February, 28th February 26. On or before 28th February 26, excess money is to be brought into India. For example, before 28-26, excess money not brought into India. If excess money is not brought to India, it will be deemed as loan given to associated enterprise and interest income will be calculated. Now the doubt is, interest income will be calculated from 30th November 2025 onwards or interest income will be calculated from 28th February 2026 onwards. That means like whether interest income is calculated from beginning onwards or whether interest income is calculated after 90 days. The answer is interest income will be calculated from 30th November 2025 onwards. Are you able to understand? That means like from after ITR due date only interest income will be calculated. Are you able to understand? So that's the point. So you have to bring money within 90 days. If you do not bring money within 90 days, interest income will not be calculated after 90 days. Interest income will be calculated from first day after the ITR due date. Are you able to understand? And here also, you should bring excess money within 90 days from date of assessment order. If you do not bring excess money within 90 days, then from first day after assessment order, interest income will be calculated. Are you able to understand? Here, advance pricing agreement is entered before due date for filing ITR. In that case, excess money is to be brought to India within 90 days from ITR filing date. If not, interest income will be calculated from due date for filing ITR. Here there is a bit of difference. See, to bring money to India within 90 days. From which date you have to calculate? You have to calculate from actual ITR filing date. If you do not bring money within 90 days, then interest income will be calculated. Interest income will not be calculated from actual ITR filing date. Interest income will be calculated from actual date like ITR due date. Are you able to understand? Here, excess money is to be brought to India within 90 days from end of the month in which APPA is entered. If you do not bring excess money within 90 days, then interest income will be calculated. Interest income will be calculated from first day after end of month in which APPA is entered. From first day after end of month in which APPA entered. So did you understand? See, case 1, case 2, very simple. Case 1, if you do not bring money within 90 days from ITR date, from first day after ITR date, interest income will be calculated. Case 2, you have to bring money within 90 days from date of assessment order. If you do not bring money from first day after date of assessment order, interest income will be calculated. Next, advance pricing agreement. This is careful, super careful you have to be. APPA entered before ITR due date. You have to bring excess money to India within 90 days from actual ITR filing date. If you do not bring, interest income will be calculated not from actual ITR filing date. Interest income will be calculated from ITR due date. So 90 days to be brought to India within actual ITR filing date. If not, interest income. Interest income is not from actual ITR filing date. Interest income is from ITR due date. Are you able to understand? From first day after ITR due date, interest income will be calculated. Are you able to understand? Next. If APPA is entered after ITR due date, you have to bring excess money to India within 90 days from end of the month in which APPA is entered. If you do not bring from first day after the end of the month in which APPA is entered, interest income will be calculated. Are you able to understand? Now let us do one problem so that you will understand better. So this is the problem. Before we do the problem, there is one more point. The point is, sir, in this case, excess money is 4 crores. But how can we bring 4 crores? Is there any alternative without bringing 4 crores? Yes, there is alternative. See, you have two options. Alternative one, bring excess money to India. India within 90 days. Else, interest income will be added. Till you bring back that money. Or alternative two, pay one-time additional tax. You need not bring excess money, but pay one-time additional income tax. Pay one-time additional income tax at the rate of 20.9664%. Okay. So 20.9664%, how much? Tax 18%, surcharge 12%, HEC 4%. Are you able to understand? So the thing is, you have two options. Whatever the excess money is there, bring excess money to India within 90 days. Or it will be deemed as loan and interest income will be added. Every year interest income is added. So it is big burden to us. So is there any other alternative? Yes. You can pay one-time additional income tax at the rate of 20.9664%. So that is alternative 2. If you pay one-time additional income tax, then no more interest income will be added. Okay. Another point is, secondary adjustment is not applicable. When secondary adjustment is not applicable? Not applicable if case A, if primary adjustment is less than or equal to 1 crore. If primary adjustment is less than or equal to 1 crore, then secondary adjustment is not applicable. If primary adjustment is done before assessment year 16-17, because the concept of secondary adjustment is applicable from 16-17 onwards. So before assessment year 16-17, if you have done primary adjustment, then there is no concept of secondary adjustment. And after assessment year 16-17 also, if primary adjustment is less than 1 crore or equal to 1 crore, then there is no concept of secondary adjustment. Are you able to understand? So you have two options. Option 1, bring back excess money to India. Else, interest income will be added. Option 2, pay one-time additional income tax. Whatever secondary adjustment is there, that is not applicable if primary adjustment is less than or equal to 1 crore, or if primary adjustment is done before assessment year 16-17. Okay. Now, let us see this question. There is Bahu Limited and there is Balla Limited. Bahu Limited holds 36% shareholding in Balla Limited. Bahu Limited is based in India. Balla Limited is based in USA. In previous year 21-22, Bahu Limited sold 6 crore worth of goods to Balla Limited. Arm's length price on Suomoto basis is 8.2 crores. SBI marginal cost of lending interest rate as on 1st April 22 is 11.25%, 1st April 23 is 12%, 1st April 24 is 13%. Bahu Limited decided to pay one-time additional income tax on 1st July 2024. So this is the question. Basically in 21-22, first of all, Bahu Limited, Balla Limited, both are associated enterprise. Why both are associated enterprise? Because they are holding 36% shareholding, which is more than 26% shareholding. So Bahu Limited, Balla Limited both are treated as associated enterprises. Actual sales 6 crores, arm's length price 8.2 crores. So how much is excess money? Excess money is 2.2 crores. 2.2 crores is excess money primary adjustment, correct? Now excess money 2.2 crores should be brought to India. Brought to India within 90 days. See, here arm's length price adjustment is done on suo motu basis. If it is done on suo motu basis, excess money is to be brought to India within 90 days from ITR due date. So, for previous year 21-22, what is assessment year? Assessment year 22-23. What is ITR due date? ITR due date is 30 November 2022, correct? So, from 30 November 2022 within 90 days, calculate 90 days means December 31, January 31, February 28. So 28th February 2023. Before 28th February 2023, excess money is to be brought to India. But when excess money was brought on, no, excess money is not brought to India. One time additional income tax was paid on 1st July 2024. So tell me, in 22-23, whether excess money is brought to India, excess money is not brought to India. Now we need to calculate interest income, correct? Because whatever the excess money is there, that will be deemed as loan given to Birla Limited. And on that loan, we need to calculate interest income, correct? How much is excess money? Excess money is 2.2 crores. 2.2 crores into what is interest rate? SBI marginal cost of lending rate as on 1st April 22, 11.25%. So 11.25% plus 3.25%. Okay, into how many days? Interest will be calculated from 1st December 2022 onwards, correct? ITR due date is 30th November. You did not bring money within 90 days. So from first day after ITR due date, from 1st December 22 onwards, you need to calculate interest income. How many days? December 31, January 31, February 28, March 31. Okay. 121 days. 121 by 365. How much? 14.5%. 10,57,507 rupees. Okay, that will be added to income of SSC. This is for previous year 22-23. Now tell me, in previous year 23-24, whether excess money is brought to India? No. Or in 23-24, whether one-time additional income tax was paid? No. When one-time additional income tax was paid? One-time additional income tax was paid on 1st July 2024. So, for previous year 23-24 also, we need to calculate interest income. How much is interest income? Excess money is 2.2 crores. What is the interest rate? 12% plus 3.25%. For 365 days, you will calculate. That means 2.2 crores into 15.25%. $33,55,000. So did you understand? In 24-25, additional income tax was paid. Additional income tax paid. When additional income tax paid? Paid on 1st July. When additional income tax paid? 1st July 24. Additional income tax paid on 1st July 24. That means 1st April 24 to 31st March 2025. When additional income tax was paid? On 1st July 24, additional income tax was paid, correct? So for this period, 1st April 24 to 1st July 24, we will calculate interest income. After 1st July 24, interest income will not be calculated because he already paid additional income tax. Now, once he pays additional income tax, then interest income will not be added to the total income of SSC till the time he pays additional income tax. When he paid additional income tax, 1st July 24. So till 1st July 24, we will calculate additional, we will calculate interest income, and on 1st July 24, anyhow he paid additional income tax. That's it, there ends the matter. Okay, from 1st July 24 onwards, interest income will not be calculated because he already paid additional income tax. Now, how much is additional income tax? Additional income tax 20.9664%, correct? So 2.2 crores into 20.9664%. How much? ₹46,12,608. Are you able to understand? Yeah, it's 31st March 25. I am sorry, Preetham. It's clerical mistake. Next, interest income. Interest income will be added for how many days? April 30 days, May 31 days, June 30 days. So total 91 days, correct? So 2.2 crores into what is marginal cost of lending as on 1st April 24? 13%. 13% plus 3.25%. 3.25% into 91 by 365. How much? 8,91,301. Is it the answer? Cross check once. Yes. Now did you understand how secondary adjustment will be done and how interest income will be calculated, how one time additional income tax is paid? I hope you got clarity. So this is all about secondary adjustment. Okay. Now let us see very important concept, section 94B. Thin capitalization or interest on loan taken from associated enterprise. Okay, very important. Definitely one 7-mark question will be asked from this concept. Okay, so be careful, listen this concept very well. There are two companies, A Limited, B Limited. A Limited is based in India, B Limited is based in Australia. Okay, now A Limited has taken loan, 100 crores loan in previous year 24-25. Let's say interest rate is 12%, interest at the rate of 12%. Now, how much interest is required to be paid? Tell me, how much interest is payable? Interest is equal to 100 crores into 12%. 12 crores interest is required to be paid, correct? For example, EBI TDA, earnings before interest, tax, depreciation and amortization for 24-25 is 30 crores. Okay, now how much is actual interest paid? Actual interest paid is 12 crores. Whether actual interest paid is allowed as deduction, actual interest paid will not be allowed as deduction. Okay, interest paid to associated enterprise allowed as deduction is equal to, what is the formula? Formula is actual interest or 30% of EBI TDA, whichever is lower. 30% of earnings before interest, tax, depreciation and amortization, whichever is lower. How much is actual interest? Actual interest is 12 crores. How much is 30% of EBI TDA? 30 crores into 30%, 9 crores, correct? Whichever is lower means only 9 crores is allowed as deduction. Are you able to understand? So, how much is total interest? Actual interest is 12 crores. Out of 12 crores, 9 crores is allowed as deduction. Remaining 3 crores is disallowed. Sir, is it disallowed forever? No, it is not disallowed forever. Whatever this 3 crores is there, this can be carry forward and set off in subsequent 8 years. Okay, that can be carry forward and set off in subsequent 8 years. See, next year also there will be limit, right? Next year also actual interest or 30% of EBI TDA, whichever is lower. In that limit, you can claim this, you can carry forward this and you can set off in subsequent 8 assessment years within the limit under section 94B. Within the limit under section 94B. Are you able to understand? Very simple. When you take loan from associated enterprise, you will pay interest. Whatever the interest that you pay, total interest is not allowed as deduction. Actual interest or 30% of EBI TDA, whichever is lower, will be allowed as deduction. If there is any interest that is disallowed in current year, that can be carried forward to subsequent 8 years. Even in next 8 years also, within 94B limit only, you have to adjust. Some confusion is there, I can understand. We will do one problem, everything will be sorted out. Okay, next I will explain one interesting case. Okay, just listen. There is Uma Limited and there is Jack Limited. Uma Limited, Jack Limited are associated enterprises. Now, if Jack Limited directly gives loan, 94B applies, correct? So that's why what Jack Limited did, Jack Limited has done fixed deposit of 20 crores with Bank of America. Now, Bank of America, keeping this 20 crores as guarantee, gave loan to Uma Limited. That means Jack Limited is not directly giving loan. If loan is given directly, 94B gets attracted. So what Jack Limited is doing, it is giving guarantee to one bank and bank is giving loan to Uma Limited. Even in this case also, it will be deemed as loan given by associated enterprise. It will be deemed as loan given by Jack Limited associated enterprise. And 94B gets attracted. 94B is applicable. Are you able to understand? So not only loan given directly by associated enterprise, if associated enterprise gives a security, gives guarantee to third person and third person gives loan to Uma Limited, even in that case also it will be deemed as loan given by associated enterprise and section 94B gets applicable. Are you able to understand? Next. Next note point, section 94B is not applicable. When section 94B is not applicable, if interest to associated enterprise is less than or equal to 1 crore. That means when you take loan from associated enterprise, you will pay interest, right? If amount of interest is less than 1 crore or equal to 1 crore, then 94B is not applicable. Section 94B applies only if interest paid to associated enterprise is more than 1 crore rupees. Are you able to understand? Next, section 94B is not applicable. Okay, not applicable in case of Indian company or permanent establishment of foreign company engaged in banking and insurance business. See, our associated enterprise is engaged in banking business. In case of banking business, their main business only giving loans and taking loans, correct? So, as part of business, if I take any loan from associated enterprise, then section 94B is not applicable. So, whenever you are taking loan from your associated enterprise, where that associated enterprise is engaged in banking business or insurance business, then section 94B is not applicable. Are you able to understand? Section 94B is not applicable in case of finance company located in IFSC, International Financial Service Center. See, you know IFSC, right? International Financial Service Center. So any company located in IFSC, it has taken loan from its associated enterprise. Then this formula is not applicable. Actual interest paid 30% of EBI TDA, whichever is lower, that concept is not applicable. So whenever any loan is taken by any company that is located in IFSC, in such case also 94B is not applicable. When you take loan from associated enterprise, where associated enterprise is engaged in banking business or insurance business, then also 94B is not applicable. Are you able to understand? So that's what. Now shall we do one problem for better clarity? In Institute Workbook, please open section 94B. Rosie Limited provides you profit and loss account for financial year 23-24 and financial year 24-25. So 23-24, 24-25. Employee benefit expense, interest paid to L&T, depreciation, income tax, profit transferred to reserves. On 23rd June 23, Rosie Limited, an Indian company, borrowed 120 crores from L&T Inc., a company incorporated in country X. So there are two companies, Rosie Limited L&T Inc. Rosie Limited is based in India. L&T Inc. is based in country X. Okay. So loan was taken. How much is loan? 120 crores. Okay. The said loan is repayable over a period of 4 years. This loan is guaranteed by Right Limited, a company incorporated in country Y. So whatever this, there is one company, Right Limited. Right Limited, this is located in country Y. Right Limited gave guarantee to L&T Inc. and Right Limited holds how much shareholding in Rosie Limited? Right Limited holds 46% shareholding in Rosie Limited. That means Rosie Limited and Right Limited are associated enterprises. Whether Right Limited is directly giving loan, is it directly giving loan? No, it did not give loan directly. It gave guarantee. Based on that guarantee, L&T Inc gave loan to Rosie Limited. Are you able to understand? In this case, whatever the loan given, that will be deemed as loan given by Right Limited, and section 94B is applicable. Are you able to understand? Section 94B gets applicable. Calculate income under the head PGBP for assessment year 25-26. First we will calculate for 23-24, then we will calculate for 24-25. Correct? For 23-24 and 24-25, first let us calculate EBITDA, earnings before interest, tax, depreciation and amortization. Shall we calculate calculation of EBITDA? How much is net profit for 23-24? 557 lakhs. Correct? For 23-24, for 24-25. 557 lakhs, 403 lakhs. Correct? Rupees in lakhs. Now, to this we will add back income tax. Correct? Add income tax. How much is income tax? 271 lakhs, 332 lakhs. Thereby we will get earnings before income tax. Correct? How much is earnings before income tax? 557 plus 271, 828. 403 plus 332, 735. Now we will add depreciation. How much is depreciation? 250, 254. Now, how much is earnings before tax and depreciation? 828 plus 250, 1078. 735 plus 254, 989. To this, we will add amortization. How much is amortization? Amortization is, so amortization is not there, interest is there. We need to add interest. Interest. How much is interest? Interest paid to associated enterprise, 562 lakhs, 389 lakhs. Correct? How much is earnings before interest, tax, depreciation and amortization? 1078 plus 562, 1640 lakhs, and 989 plus 389, 1378 lakhs. Let us check the answer. How much is 1640 EBITDA, and here EBITDA is 1378. We got the right answer, right? 1640, 1378. Now how much is actual interest? Actual interest is, first we will do for 23-24. How much is actual interest? Actual interest is 562 lakhs. How much is 30% of EBITDA? EBITDA is 1078 lakhs. 1078 lakhs into 30%. How much? 323.4 lakhs. So out of these two, whichever is lower. So how much is interest actually? Actual interest is 562 lakhs. But whether 562 lakhs is allowed? No. Out of 562 lakhs, 323.4 lakhs is allowed as deduction. How much is balance? 238.6 lakhs, that is disallowed in 23-24. Disallowed in 23-24. However, this 238.6 lakhs, it can be carried forward to subsequent 8 assessment years. Are you able to understand? And they can be set off within 94B limit. So you can see in 23-24, how much is allowed? Hey, I am sorry. I did one calculation mistake. It is not 1078. How much is EBI TDA? 1640, right? 1640 into 30%. How much? 492 lakhs. So, out of 562 lakhs, how much is allowed? 492 lakhs are allowed as deduction. How much is disallowed? 70 lakhs is disallowed. Are you able to understand? Whatever disallowed 70 lakhs is there, that can be carried forwarded to 8 assessment years within 94B limit. Now, for previous year 24-25, how much is actual interest? Actual interest is 389 lakhs, correct? Actual interest 389 lakhs or 30% of EBI TDA. How much is EBI TDA, earnings before interest, tax, depreciation and amortization? 1378 lakhs, correct? 1378 into 30%. How much? 413.4 lakhs. Out of these two, whichever is lower means 389 lakhs allowed as deduction. Now, in previous year 24-25, how much is 30% of EBI TDA? 30% of earnings before interest, tax, depreciation and amortization is 413.4 lakhs. Out of 413.4 lakhs, 389 lakhs of 24-25 is allowed. Balance is there na? How much balance is left? 24.4 lakhs. From 23-24, how much is brought forward interest from 23-24? Brought forward interest from 23-24 is 70 lakhs, correct? So, out of 70 lakhs, you can set off, out of 70 lakhs, 24.4 lakhs you can set off in 24-25. Balance 45.6 lakhs that will be carried forward for next 7 assessment years. Are you able to understand? So, whatever 24.4 lakhs is there, that you can set off. So, 24.4 lakhs you can set off with brought forward interest from 23-24. Are you able to understand? See, this year how much is limit? 413.4 lakhs is limit. But how much is actual interest in current year? Only 389 lakhs. Na? Within balance limit of 24.4 lakhs, you can set off brought forward interest from 23-24. So, brought forward interest is 70 lakhs. Can you set off 70 lakhs? No. Only 24.4 lakhs limit is available. So, out of 70 lakhs, you have set off 24.4 lakhs in 24-25 and balance 45.6 lakhs you will carry forward for next 7 assessment years. Are you able to understand? So, that's the answer. You can see 413.4 lakhs and 45.6 lakhs will be carried forward for 7 more subsequent years. Now, did you understand? 94B, very important. Illustration 7, same, just like illustration 6 only, question 6. You please try to do on your own. Very important. Section 94B, definitely one question will come in the examination. Okay. So, I hope you are clear. Okay, shall I wind up? Okay, that's it. We discussed the secondary adjustment and section 94B. Thank you very much. Stay tuned for revision of remaining chapters. Thank you. Bye.